So you found a business you want to buy. Now what? You're excited to move forward, except you need to fill out a letter of intent. So what is a letter of intent, also known as the LOI? It basically establishes the pattern of the transaction, what you want to happen before it happens. So in today's section, we're going to go over everything you need to know, the do's and don'ts, the contract provisions you absolutely need to have, and what you need to stay away from. So when you're ready to fill out yours, you'll know what to do. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth or diversify your wealth by buying a profitable business, or a W-2 employee sick and tired of the rat race wanting to buy a profitable business to get out of the rat race, you are in the right place. Please subscribe to my channel. Don't forget to hit the bell and you'll be notified every Thursday when new videos come out.
Hey, what's up everybody? Welcome back. Today we're talking about the letter of intent. As I said at the beginning, this is specifically for those of you who are doing an asset purchase, not a stock purchase. This is an asset purchase that will eventually lead, the foundation of this letter of intent for asset purchase will lead to an asset purchase agreement, which will be legally binding. This is a non-legally binding agreement. However, I would say disclaimer, I am not an attorney. This is a template that I've used before, but I also have buyers procure their own attorney in your state, and this is only for U.S. residents or U.S. businesses. If you're outside of the U.S., not sure what you will use, but if you're in the U.S., you can use a letter of intent to purchase assets of a corporation. This could be the assets of a limited liability company, whatever. The legal entity will change, and so will everything. You know, your name, address, city and state, your email, your seller's information, seller's address goes here. So let's dive deep into each section, okay? So this is, boilerplate template information. The purpose of this letter is to summarize the principal terms of the proposal between seller one and seller two. Sometimes it's a husband and wife. Sometimes it's two partners, collectively called the seller. And buyer one and buyer two, if in case you have a partner or your spouse, for the transaction of the business assets of XX whatever corporation, which will also be known as the business, and the transaction where the buyer and the seller shall refer collectively as the parties in each party. So this is, very basic. So section 1 is the sale of business assets. A lot of the language here would mimic or would mirror some of the legalese that you'll have in the asset purchase agreement and the final product, which will definitely be put together by your attorney, which it will be legally binding. So in this case, but what it does is it irons out the business points of the deal. So if you're buying, this is the sale of business assets. This is subject to the satisfaction and conditions described in this letter of intent at the closing of the transaction. Buyer proposes to acquire all or substantially all of the business assets in connection with the operation of the business, free and clear or encumbrances or titles or liens, right? This transaction will include except the excluded assets, which I'll show you number 2, but without limitation. This is not to be an all exhausting list, but just to sort of reference to everything. There could be more things, but this is just will guide the conversation. All furniture, fixtures, and equipment, all tray signage and tray fixtures, all client names and contact information, point of sale, accounting software, signable licenses, computer hardware, software licenses, all business records, all transferable government licenses and permits, customers with trade secrets, and so forth and so on. You can interchange, you can add, you can take away, but the point is that it gives, at the end of it, it's going to be all the assets pertaining to the business. All usable inventory. We'll discuss more about inventory in the actual purchase price. All marketing materials, telephones and fax numbers, all leasehold improvements, all vehicles registered to the business will be transferred free and clear to you at the end of the transaction, at the close of escrow. Those who work with me, in my mastermind and work with me as a coach, you will have this document, and we'll work in concert with your attorney, making sure that everything is the way it should be. But this is just a guiding, it can be editable. All right. Number 2, excluded assets. These are the items that will not be coming, that you will not be purchasing in the transaction. First and foremost, it's cash at hand. You do not want to purchase the cash on hand or the depository amounts or whatever is in the bank accounts. These usually stay with the seller. They have been earned by the seller and will stay on by the seller. Accounts receivable usually doesn't come to the buyer. Usually the seller will keep the accounts receivable, which has been earned up to that point. Remember, accounts receivable is revenue that has been earned but not collected. So it's not quite cash, but it's a cash equivalent. It would be as a current asset in the balance sheet. Whatever miscellaneous personal effects of the sellers and sellers' personal laptops. It could be a bunch of other things that you want here, but this is just, again, it's the guiding principles of the exclusion of assets. Now, one thing I should mention that is not here and that you hear me talk about every so often is working capital. Working capital is never really a part of an asset purchase, and it's something that can be negotiated. A lot of lenders would like to offer working capital if you have a strong buyer. You can ask for it, but it's not as necessary. But it is critical if it is a stock purchase, because when you're doing a stock purchasing, you're buying everything in that balance sheet. You're buying the assets as well as the liabilities. You're buying everything contained. By buying the stock, you're assuming everything, liabilities or future liabilities. So working capital plays a bigger role in a stock purchase than it does in an asset purchase. However, with that said, this is something that you have to think through when you're making an offer. Is once you do go through the process of valuing the business and you have an estimation of value, opinion of market value that you can defend, with an offer that you feel comfortable that is the right offer to make, you will probably address, there's the buckets of, you're going to have your down payment. And if you're thinking about getting this financed through an SBA loan, you're going to have to figure out a way to have the post-closing liquidity. Now, the working capital is the third bucket of cash. That if you buy it right, less than the asking price, that may be built in, because if somebody's wanting, $1 million for a business when you can offer 900,000, and the offer is accepted, thus the $100,000 difference could be the working capital that you would have to pay for. So those are a little bit of working capital when it comes to excluded assets. Number 3, the purchase price. This is really very important. Getting to the meat and potatoes here. So usually we like to make an offer. So in this particular scenario, this example, if you will, is for a $2,500,000 purchase. And it's spelled out in dollars and cents. It's written, and it's also in numbers. Number A, you first have your earnest money. So in this particular case, I usually suggest, it's kind of a token of good faith. This money you can, get back if the deal falls out of escrow during due diligence or you don't get the loan, the loan contingency is not removed, or whatever happens, the deal doesn't consummate, then you can get your money back. So you want to offer a little bit. You don't want to offer too little. In a $2.5 million transaction, that 25,000 is 1% of the value of the deal. So if it's a smaller deal, you may get away. If it is less than $1 million, you may get away with 10,000 or even 5,000. But you want to show that you have some good faith, which is usually delivered. Once the letter of intent is signed both ways, is delivered to the attorney or the escrow company involved, whatever state you're in. Some states are attorney states, some states are escrow states. Regardless, there's going to be an escrow where the funds are held by a neutral third party. Next, we go into seller financing, if any. In this particular example, we have a 10% seller carry on the deal. So the seller, you set out the tone on how you want to lay out the transaction. So you want the seller to carry 10% of the deal at a rate of 7% per annum, paid monthly, amortized over 10 years, and with a balloon payment on the balance of 60 months. Now, keep in mind that if there is a SBA loan, chances are that you're not going to be able to have a balloon option because it has to mirror the amortization of the SBA loan. So it may have to carry the 120 months or 10 years. Even then, if the deal is kind of lean on post-closing cash flow as far as debt service coverage ratio.
You're stuck and trying to figure out how to buy a business. I know what it's like. I've been there. I know you have questions that are specific to you. So let's connect. Let's chat. I want you to go ahead and reach out to me via email. My email address will be at the description section of the video down below, or you can begin a comment and let's connect that way. I want to help you in your journey. Thank you so much for watching my videos.
Then the lender may actually put a moratorium on the seller's ability to collect for the first 2 years. I don't want to get too much in the weeds, but this is an option, right? You get the seller to carry some of their belief in the business, to back it up. If they really believe in the business, they should be able to carry some paper, which means that, everybody has a little bit of skin in the game. Inventory. Okay, this is language that is going to be thoroughly fleshed out during the asset purchase agreement. But for the sake of conversation, we say that in this case, there is the purchase price shall include about $50,000 worth of inventory or sellable inventory. Now, if the actual inventory at the end of the due diligence period is higher than the $50,000, and you're getting that, then say it's $100,000, well, then the purchase price and the note that the seller will be adjusted accordingly because you're getting more than that you bargained for. Conversely, the opposite is true. If it is actually less than less than $50,000, there will be adjustments. There will be adjustments to be made at the close of escrow, before the close of escrow, during escrow. As far as inventory is concerned, inventory matters in some industry. It doesn't matter in others. It really depends on the industry that you're that you're actually purchasing into. And then the remainder of the purchase price will be settled at closing. And that will include your down payment, the loan, the lenders, the money coming from the bank, and whatever else will be settled, less any adjustments agreed upon. Number 4, you get a condition of the assets. If there are deficiencies, all the assets are to be transferred as is, meaning that you may have fully depreciated assets that you just take on. They will be free and clear. And the seller will make their best effort to make sure that they are in working order. But it's hard to say sometimes. If you have old equipment, it may or may not be in 100% working order, something you have to settle during an escrow. Also, 5, we get into tax clearance certificates. Sellers is to obtain a tax clearance certificate or appropriate letter of good standing from the government tax authority. So whatever state you're in, California, New York, Texas, Florida, the bigger states, you want to make sure that you get some certificate of clearance, at the county level, at the city level, for those of you who are actually paying business tax to the city, if you're paying any taxes to the county, if you're paying any taxes to the state, all of those clearances will be have to be settled, have to be acknowledged. The last thing you want is to buy a business that has debt to the city in terms of tax debt. That'll be settled through due diligence. Conditions of performance. Now, these are sort of these are the contingencies that have to be removed prior to the closing of escrow. The buyer shall enter into a new lease. Remember, you're not buying the stock, which means you're going to have to get a new lease from the seller's landlord that will be acceptable to you as a buyer. If the lease is not acceptable, this may be, may break the deal. So the approval of buyer by franchisor, if applicable, if you're actually buying a franchisee, the franchisor has the first right of refusal. If they choose to forego their right of refusal and they want to have you in, there'll be paperwork involved to make sure that everything is kosher with the franchisor. The seller shall transfer clean title of all assets. All seller service contracts shall be assigned to the buyer at closing, etc. inspection and finance and contingency period. Now, I've seen it anywhere from 30 to 90 days. I think 60 days is customary. Especially if there's a loan contingency. If there's no loan contingency and this is an all cash transaction, you may be able to reduce it to 60 to 30 days. But let me tell you, having been involved in a bunch of escrows, you need every day, and these are working days. So it's not like you're gonna 30-day escrow means 30 days. It means escrow companies only work Monday to Friday. So, but usually the things that come into play with the inspection, and the inspection is the due diligence, is the financial and legal due diligence that you're going to do on the business, and also the financing. You bring in a loan, and so you're going to inspect the records for you, and the lender is going to inspect the records as well. They're going to request tax transcripts from the IRS to make sure that the tax returns match. You're going to be looking at profit and loss statements. And it says that the lender will require, it's not necessarily that you need it and you need it for yourself, but the lender will need it. If the buyer determines that for any reason the business has material deficiencies and gives right of notice of terminations to the purchase agreement, then the buyer will get their earnest money back. You really want to watch the timeline in escrow, making sure that if there is any money due to you, that you don't violate the covenants of the escrow and forfeit your right to collect on the earnest money that you put in. Okay, during this period, the buyer will obtain a firm written commitment from a commercial or SBA lender. If the lender issues the commitment letter, you can thus remove the contingency from escrow, and same as when you're done with your actual financial due diligence and legal due diligence, all those, escrow will have to acknowledge that you are hereby removing those contingencies so that the escrow can close. Without it, escrow will not close, and you may have problems. So post-closing assistance, this is when you ask the seller to stay on for a period of time. 30 days is average. It could be 20 hours a week. It could be 30 hours a week, whatever you deem is necessary, depending on the complexity of the business. This is very, very, very important. This section right here, discontinued marketing. In other words, what we're saying is that you're going to have the exclusive right to look at this deal, and no one else will be looking at this deal while you're looking at this deal. So you're tying up the business into escrow for say 60 days to inspect it, to make sure that this is something you want to move forward to, which means that, let's read on. Upon the execution of the definite of agreement between the party, seller agrees to discontinue marketing. So once this seller has signed the letter of intent, it will not be able to accept any more offers or risk being in default of the letter of intent. So, and it goes both ways. You want to have the opportunity to inspect every piece of paper, anything that makes sense, anything that is material for the business, make sure that you're making the right decision. At the same time, the seller is letting go, is actually putting the business in the back burner because he's going to tie it up to you, so he won't be able to market it. So the seller is going to make sure that you are a qualified buyer as well. It goes both ways. You must prove that you're a qualified buyer, and the seller must prove that they're a qualified seller. But in order for that to happen, you need to have a period of time when the business is no longer marketed and no more offers are accepted. So this is kind of important, and I've seen it when it doesn't happen and it doesn't go well, and then 3 or 4 offers come in. The seller can do whatever they want, and then you're at a disadvantage. You like to give a period of termination. This letter of intent offer will automatically expire within 5 days. The reality is, if you really want the business, if they come within 7 days, you probably will take it. This is more of a sales tactic. The governing law of this letter of intent shall apply to whatever state you reside and the business is in. So check with your attorney. Confidentiality. The terms of this letter are intended to be confidential to the parties and the representatives. Neither party may disclose the existence. So it's mutual confidentiality is paramount. We don't want vendors, employees, or the market to know that this business is actually being considered for a sale, or we are going to have employees quitting and all kinds of bad things. You don't want customer, vendors, and employees to know what's going on until the time is right for them to know what's going on. Expenses. Each party will incur their own expenses and be responsible for their own expenses. It says here again, this is a non-binding agreement, meaning that it's meant to allow due diligence and the financial contingency to be resolved with the understanding that there is a period of time during escrow that an asset purchase agreement, which is there's going to be the one that is going to supersede this one, will come into play. Headings, there is a broker involved. There's a section for the broker here. The closing, you want to estimate, if you're doing a 60-day contingency due diligence period, when do you want to close? You want to close, within 90 days, no more than within 90 days. Time kills all deals. If you're not moving quickly on this deal, bad things may happen. And then, the intent of this letter is to serve as description. Again, it just basically tells you that this irons out, puts forth the business points in the deal later to be fleshed out with the legalese, which you want to have an agreement with the seller as to the business points and let the attorneys later figure out how to best protect you. You don't want to have the attorney put out the legalese and then forget about negotiating the business points, which, sometimes I've seen it happen that way as well. So, this is, the signatures, buyer 1 and seller 1 and seller 2. And that's it, guys. I mean, this is really as a comprehensive of a letter of intent you can get when it comes to letter of intent to do an asset purchase. Please let me know if you have any questions. Thanks for watching this video.
Limited time, I'm giving away my cash flow calculator, now downloaded a couple thousand times over the last few months. It's a great tool if you're trying to figure out how much cash flow is there once you buy a business and get a loan, which is why I specialize in. So it is my gift to you. All you have to do is follow the links below and it'll be yours to keep in exchange for subscribing to my channel and being one of my viewers. Thank you so much.